Hi everyone. So something strange is happening in the Indian economy. For example, if you take a look at this graphic, you would realize that India is set to become the fourth largest GDP, beating Japan. So this will give you a feeling of pride. You will think that, everyone in India is becoming richer. On the flip side, if you read headlines like these, that close to 80 crore population is availing free ration. So what exactly is happening? On the one side, we are saying that, we are a very big GDP. We are a very prominent GDP. On the flip side, our passport ranking is falling. INR has weakened to its lowest ever point. People are availing free ration. So three questions come. Question number one, that is India's GDP fundamentally strong or weak? Number two, if it is weak, then what precisely is it where we can focus and improve our GDP? And third and most importantly, that if you are an investor, should you be investing more money in India right now because markets have corrected and it might become a great buying the dip opportunity? Or should you start focusing more on the US market now or some other market? So let's have this conversation in a very no-nonsensical, data-driven manner. I am not here to present my opinions. I am going to speak everything with facts and data. So let's answer question number one with actual data. That is India's economy fundamentally good or bad at this juncture? Now, there are many facets to analyzing the economy, whether it is growing, not growing, etc. But one key data point that we need to track is the real GDP growth rate. Now, this is one of the most important numbers which is tracked by the economist, by international investors before they make investments in any economy. Now, here is the entire data. The source of this data is Indian Express, and they have done a good study on this topic and have given the exact real GDP in a lakh crore terms and have explained the real GDP growth rate. Now comes a natural question that what is the difference between real and fake GDP? So if this is real GDP, what is the meaning of fake GDP? So basically the point is that there are two types of GDP. One is called as real and another is called as nominal. Now nominal means stated GDP. Now stated GDP means it's a combination of real GDP plus inflation data. Okay. Now inflation in the economy, as we know that as per the Monetary Policy Committee of RBI, we have an inflation targeting rate of 4 to 6%. Okay. Usually we would not want the inflation to be very high. So sometimes when you read GDP headlines that India's GDP has grown by like 9% or 10% or 11% or something like this, we might be speaking about nominal. What we need to care about is the real GDP. Now, real GDP means that if you adjust things for inflation, if you take inflation out, you get the real GDP. Now, this real GDP data is very, very important. And unfortunately, India is not painting a very rosy picture, because if you consider the GDP or real GDP growth rate, this column will exhibit this. Now from 2019, if we consider the last 5 years, our real GDP growth rate is close to 6% on an average. Now this situation becomes even grim if we consider the last 10 years data. Now in that, if you take a look at the data, then the average GDP in the last 10 years is only 5% real GDP growth rate. Now when people throw or economists throw such numbers, 5% GDP, 6% GDP, it doesn't hit us, right? I mean, we might think that, okay, 0.5% here, there, 1% here, there. How does it matter? Well, it matters a lot because India is growing from a small base. Now, just for context, India right now is roughly a $3.5 trillion economy. China in 2007 was a $3.8 trillion economy. Now they are close to $18 trillion economy. So they have achieved a lot of growth. Why? Because once an economy becomes big, right? Even if they are adding like maybe 2% real GDP, it expands their base more. Now, since India is growing from a very small base, for us, a good GDP number would be at least 7%. But unfortunately right now, and in the previous quarter, our GDP grew only by 5.4%. It is estimated by RBI that we will grow at 6.5%. This is a very slow moving GDP. So comes the natural question that, okay, why is it that our GDP is growing slowly? Now this in itself is a topic worth 3 hours of conversation, but there is a very good data point that I was able to find for you. So here is the data point, and you need to understand this column. This is called as private spending column, right? And here, the first key fact that you need to understand is that almost 60%, 60% of our GDP comes from domestic consumption. Why? Because India is a land of aspirations. We have a lot of population. Our demography is young. So we consume a lot more things. So therefore, our domestic consumption is very important contributor to GDP. Now, what is happening is that if you take a look at the growth rate of this column, PFCE, जो private consumption hai, if you take a look at the growth rate of that, it is slowing down. You will say that, okay, this is a very good number. Well, because of the fact that 2020 people hardly consumed, there was negative growth rate. So it got somewhat compensated here. But since then, net, it's not as if that we are growing at a very fast rate. If we do a CAGR calculation from 2014, last 10 years, we have only grown at 5.9%. If we take 2019 onwards, we have only grown at 4.8%. Now comes a natural question, okay, why is our private consumption going down? ऐसी क्या problem हो गई है? Well, the situation there is that the government has introduced crazy amount of taxation, little bit of discretionary income also, even that has been wiped off. Why am I saying it? Because again, you can take a look at the data point, which is called as savings to GDP ratio. Right now, India's savings to GDP ratio is at a 5-decade, 50-year low. So this again does not paint a very healthy picture. Also, folks, in case you are interested in learning more about economics, finance, stock market, how to protect your wealth, I teach a macroeconomic driven course. It has limited seats. It's a live course. It has a 95% completion rate. In case you are interested, you can check the links in the description and comment box. I run maybe like 3 such courses in a year. So in case you are interested in learning how to pick stocks, how to do fundamental analysis, macro analysis, understand economics, then I teach this course in very easy, simple to understand language. Please check the links in the description and comment box. The feedback has been excellent. With that said, let's move over to the main video. Now, despite these negative sentiments around high taxation, consumption not picking up, we seem to be in denial. For example, a classic case study here would be that, for example, that this was a recent news and this was released by PIB. And here you can see that this announcement was made on 12th December 2024 that India's FDI journey hits $1 trillion. This is an economic milestone and we are doing so wonderfully well. This is a very good graphic was made that, you know what, FDI, जो foreign investments हो रहे हैं India में, that is just scaled new highs. Is that really true, right? And are we even acknowledging the problem? Why? Because if you actually study the relevant number here, that number is net FDI. It's not about FDI. Okay, people are maybe investing 100 rupees here, but if they're pulling out 80 rupees back, then the net FDI is only 20. So is the net FDI growing or not? That is a more relevant matrix. For example, this study comes from the print which analyzes net FDI on year-wise basis and the source is RBI data. So this is relevant data. And what you will notice is that, for example, if you consider like in 2021, the net FDI picked up, then it has been consistently going down. So comes a natural question, then why is it that FDI, which is foreign direct investment, is kind of shrinking in the Indian market? Well, there are a lot of reasons for that. But one quick reason is that India as an emerging economy, foreign portfolio investors are not betting on it on a long-term basis as of now. Now, multiple reasons might be there that, for example, we are not creating the type of companies that will attract these type of investments. Investors are not finding any alpha. There are complicated labor laws. There are complicated land acquisition laws. The problems can be 100. This is beyond the scope of this video as to why FDI is shrinking. That in itself is a video. But what I wanted to explain it to you is that our net FDI are shrinking as we speak. You will see that how much net money has come. This green candle indicates how much net money is being added and this red money is the amount of money that is being expatriated. And this is what the worrying sign is, that while FDI is flowing because there is more money that is printed in the world, that if 48 units of money is coming, 34, 35 is going out of India. So net हमारा इतना कोई फायदा नहीं है, right? So this is a problem that is not getting solved for India. Now, what is the bigger problem here? Well, the bigger problem is that if you take a look at INR depreciation, this is going out really fast. For example, if I show you the entire history, so आप ये max देख सकते हो, right? ये, for example, take a look at last 5 years. We are sitting at the weakest INR right now. Now, the problem here is that if INR becomes weak, then it should give more incentive for foreign investors to come and invest in India. Now, why is that the case? Because it's very simple. So let's work through an example. So let's say in 2014, 1 USD was equal to 60 rupees. Okay, so with 1 USD, you can buy 60 rupees. In 2025, with 1 USD, you can buy 85 rupees. So basically, these guys can buy more of INR. So it has become cheaper for them to buy INR or invest in the Indian economy. But are they investing? They are not. and therefore we are seeing a net outflow of FDI. Now what about FII? So FII are market participants. So foreign investors, जैसे वो basically जो equities वगैरह में करते हैं. There again, take a look at this graphic on money control. You yourself will be able to understand that for the last 3.5-4 odd years, even FIIs, foreign investors, have been net sellers in the Indian market, and this is again proving to be a big problem. We do chest thumping that, you know what, we don't need like foreign money. हमारे SIP वाले संभाल लेंगे, DII वाले संभाल लेंगे, etc. etc. That's a matter to celebrate, but to cut the long story short, we do not build wealth just by consuming domestically. We have to export some kind of service or get foreign investments in. Unless we are able to do that, there is no wealth growth. Again, let me explain it to you by using a simple example. For example, we built very big leader statues and whatnot. I will not name the statue. Now think about it, that is it really generating real wealth? For example, if you are a tourist based in Orissa, up until this point, you might be going to Goa. Now let's say a statue comes and you go to that particular state to view that statue. Now, have you really contributed to the GDP or wealth growth of the country? Not really, because that money that Orissa tourist might have spent in Goa, now he is going to some other state and spending it. So this is not real wealth growth. The real wealth growth would be that because you built that statue, a lot of foreigners are coming and bringing foreign wealth with them. So that unfortunately is not happening. And unless we export something, we cannot say that our economy is fundamentally strong. Now this again is an interesting graphic that just builds on the point that I was explaining you, that what about Indian companies? Are they even investing in India, or are they going outside India now? Even Indian companies have started to spend more money outside India, because at an aggregate level, even they are not seeing the return. So this can be seen by this graphic. These are foreign investments by Indian companies and they are spending more money here. So just to summarize this section, there have been three problems. Number one, our real GDP growth has been really slow. Number two, there has been a significant slowdown in FPI and foreign institutional investments in India. And number three, that despite the currency devaluation and INR falling to its lowest levels, we are still not seeing foreigners or foreign buyers buying the Indian market. So then comes a natural question that, okay, what can we do in order to turn around this situation? So again, we have to just work on that same principle and we need to do three things. Number one, we need to bring in foreign investments. We need to accelerate our GDP. And number three, we need to build some kind of competitive advantage. Now, let me start with point number three. What is the meaning of building competitive advantage? Now, if you consider cities like Pune, Hyderabad, Bangalore, then these were IT hubs. One could argue that the growth of IT industry propelled these cities and literally built wealth in these cities. Why? Because IT workers in India were working for multinational corporations across the globe, especially US, Europe based, and they were bringing US dollar and euros back to India. But unfortunately, IT has been on a slow track. But nevertheless, the growth of the IT industry indicated some kind of competitive advantage for India, that we had a young demography, hardworking, English speaking, good at tech. So all that combination allowed us to bring foreign wealth. Now in 2025, we are sitting at a crossroad wondering what that next layer of growth for India would be. Our manufacturing is growing at maybe like 2-3% a year, which is really slow. IT is slowing down. Tourism, we are really bad at it in terms of bringing foreign tourists. In fact, we have been losing ground. Goa has been getting a lot of negativity, but honestly, foreign tourists have dried up in India at a pan-India scale due to safety issues, bunch of other different things. So there seems to be no strategy. Let me present a counter question to you, that what are some of the fast growth industries in the world? So this would be semiconductor, artificial intelligence, robotics. Now let me ask you question number two, that which companies in India are throwing their gauntlet or working out in this space, and you see them becoming like top 3, 4, 5 players in the world. So right now is zero. There is no one literally which is representing India at that scale where we can win the semiconductor race, artificial intelligence race, crypto race, robotics race. We are not even trying to win those races. So then comes that, okay, fine, since we are unable to export and generate those exports, what about we make Indian market very lucrative for investors, that we do something, for example, Dubai, what it has been able to do substantially well is that it has been able to bring a lot of foreign wealth through real estate investments. So can India do something? Now this comes down to a very simple concept of appealing to the investors. Now investors, for example, if you are an American investor or you are a European investor, why would you look at the Indian market? Very simply put, that if someone can come and invest 100 euros and can quickly make 20% return on it, or the return is adjusted as per the risk. Now what is happening in India over the last 5-6 years is that our GDP has been growing at 5-6%. US's real GDP has been growing at 4 or 5%, right? So then comes a very natural question कि यार फिर US में पैसा क्यों ना डाल दें? Just for context, US's GDP is roughly $30 trillion. India's GDP is $3.5 trillion. We are almost 9 times smaller than the US. So the risk of investment in India is fairly high. And since if we are not giving like even 5-6% growth or giving almost equal growth to foreign investors, that is the reason why they are leaving the market. So building some kind of investable asset class in India is very, very important now. Up until this point, you could say that, okay, this was the Indian stock market, which was giving excellent returns. But if you adjust it for rupee depreciation, honestly, you would see that those returns are not like crazy returns compared to the US market. In fact, US market has done better than the Indian market over the last few years. Now, one of the key things that needs to happen fast is that we need to cut taxes. Now, if there is a kind of a tax cut, then it will propel our markets also. It will give more money for consumption also, which will accelerate our GDP. But unfortunately, then the counter question becomes that, hey, how are we going to spend money on freebies, this, that stuff? So for that, now I can keep on ranting about freebies, that freebies should go away, this, that stuff. But a more sensible point here would be that tax rationalization could take place. For example, instead of taxing a handful of 2% tax, direct taxpayer, the tax net can be cast wider. Maybe 5% people can be brought into the tax gambit and be made to pay direct taxes. That will relieve some pressure and will give some amount of money or spending power to people who are already paying crazy taxes. This needs to happen. Now, I would request you to share this video with your friends on different social media platforms. Take out this clipping, do something about it, because if there is enough social media noise, maybe something will happen or something positive will happen on this budget. Now comes the final section that, okay, if nothing happens and if there is no tax cut, there is no fast fix, then what is it that we are looking as investors, and is there something that we can do? So number one concern is that markets are already falling. We have corrected by roughly 11% from the top on Nifty. Will we fall more? See, 10-15% correction on the stock market happens very frequently. This is not the first time or the last time this will happen. But does it mean that Indian markets will vanish? The short answer is no. Why? Here is like mutual fund SIP contribution, right? And here is a very interesting graphic on it that in September of 2024, the SIP inflow was at an all-time high of 24,509. This was 52% higher than the 2023 data. Now, yes, in 2024, towards the end, the markets have started to correct. So some people would have stopped their SIP, this, that stuff. But we can't deny the fact that a lot of SIP money is coming into the market. So it's not as if that if you're a stock market investor in India, you will lose your wealth. No, in fact, stock market is likely to do fine. We might grow our Nifty at 12-13% CAGR. But the inflation in the economy will be high. So the real growth rate on your investments in India might only be 2-3%. Now, the reason why I'm saying that is very simple, that the segmental inflation for you, people who are investing in the stock market, works very differently compared to how it works for someone who's living in a village, right? Now, India's average inflation might be 5%. So that includes people who are availing freebies, who are living in village, owning their own house. But if you're someone who's investing in the stock market, most likely you're living in like a metro, all that stuff. So for you, inflation will be 10. And if your Nifty is growing at 12 for you, then the real growth rate for you is only 2% after taking so much risk. So this is one, but having said this, you don't need to worry about the fact that Indian market will get crushed by 30%, 40%. I don't think that that is likely to happen unless there is a world level fall, so to say. So then comes the second question that, okay, fine, but would it make more sense for me to go to the US market now? Because I do not see like artificial intelligence, semiconductor opportunities in India. So the short answer is yes, a part of your portfolio should go to US stocks. For sure. The reason is very simple, that there are certain types of companies that you can explore only in the US. Now, which type of companies you can pick in the US, I'll write a detailed note on my member community tomorrow. So again, a small pitch. In case you are interested in learning about fundamental style of investing, I teach that. Just try member community for a couple of months. That itself will give you a lot of confidence. The next point being that, okay, fine. If I reflect on the last 10 years, it hasn't been that great from a GDP growth perspective. Data is now coming out. It's not looking very nice. Even from like FII investment perspective, it's not looking great. If situation continues like this for the next 5 years, then what happens to my investments? Well, we will witness a fairly high inflation in India. I'm quite certain that that is going to happen. So you need to understand how to protect your money, how to do hedging of your money, have some positions in international stock, diversify your portfolio really well. Doing these things is going to be non-optional now. Just simply doing SIP, making like 12% return, and then wiping out that wealth by paying 11% through inflation, it does not make sense. Please understand this. Please rewind this video, watch it a couple of times. It will give you more understanding. There is also a link in the comment and description box. In case you want to learn about the falling of INR and its impact on you, please watch the video. Watch these type of macroeconomic videos. Subscribe to my channel. You will learn more. Thank you so much for watching, and I'll see you soon.